Welcome back to Talk Property to Me. My name is Brad East.
And I'm Aaron Downey.
So today we're going to be basically running through part one of two. We're doing a two-part series on first-time property investors in Australia. Today is going to be all about finance, so the finance side of, finance tips for first-time property investors, and then the next episode, part two, will be all about the property side. So bit of an outline of what we're going to go through. So first segment, or first part of it, is going to be how much deposit do you need? Mm-hmm. We're going to talk about some of the eligibility for government schemes and if there is any at all, how banks assess your borrowing capacity, and how that links back to rent vesting as well. And essentially what is rent vesting, and whatever else we come up with on the way. So I guess we'll get straight into it. The deposit. Now, most lenders will require a 20% deposit without if you don't want to pay lender's mortgage insurance.
Yeah, generally speaking.
Yeah, generally speaking. So just to explain what lender's mortgage insurance is, it's a fee or a premium that the borrower pays to protect the bank. Because heaven forbid a bank...
To a third party.
Yeah, to a third party insurer, usually QBE or Genworth or so on. Now, heaven forbid the bank actually takes any risk, so you pay a premium to protect the bank. Yeah. So what that was originally put in place for was to protect the bank for any shortfall. Yeah. So let's say you bought the place for $500, your loan's $480, and you foreclose, you don't pay your loan back, and they sell it for $470. Yeah. That insurance premium is designed to pay out that $10,000 loss to the lender. Now, I can't. In 10 years, I don't think I've ever seen that happen. So it's a lovely fee that gets paid to these big insurers that, in my opinion, has never really been used. But anyway, that's my rant on that.
And I think to touch on the LMI, so in terms of that, I think we've touched on it before. We know that property's not really affordable in Australia right now, and a lot of people are having to pay it. So 100%. I think... we said generally speaking 20% deposit to avoid that LMI waiver. I reckon you could probably give some more advice around what's the alternative. So what's the sort of a general loan size or deposit that you're seeing now?
You can get away with 5%. Yeah. So and honestly, I would never, recommend that you don't proceed just because of LMI. If you've got the capacity to proceed, so you've got the borrowing capacity, you've got everything else, and it's just the deposit and you've got to pay an LMI premium, you're going to make that back in the first couple of years in capital growth. Yeah. It makes no sense just going, I don't want to pay that fee. Yeah. As terrible and ridiculous as that fee is, you're going to make it back. Yeah. There's no way around it.
If you buy it at the right time, you're probably going to make it back in the first 2 months.
The only other way around it, and you can do this as an investor as well, is to get a guarantor. Yeah. So getting a guarantor doesn't increase your borrowing capacity; it increases your deposit.
And that's an LMI waiver.
Yeah. Well, you're borrowing 20% against your parents' house. Yeah. So you've got two properties involved. 80% of the loan secured against the property that you're purchasing, and the 20% is secured against the property you're purchasing and your parents' house. Yeah. So that's another way to avoid that LMI. But again, you can get away with as small as 5% deposit plus the LMI fee plus stamp duty plus costs. So generally that sort of equals around 10%.
For first-time investors, because this is more so what it's focused towards, but are there LMI waivers for certain professionals or are there certain banks who offer LMI waivers for certain people? So you got your professional lenders, so ones that will lend to professionals such as accountants, solicitors, that sort of thing. Yeah, they generally require a 10%, so it's halved. So you'll get away with 10% deposit, no LMI. Some lenders also, they're called medico lenders. So for medical industry, I know that ANZ at the moment will do 5% deposit for a doctor, so registered under APRA doctor, or anyone listed under APRA. Yeah. So that is 5%, no LMI. So that's obviously a good one. There's a few that are doing 85% for nurses and some other industries as well. That's good to know.
But generally speaking, yes,
some industries, yes, you can get away with less deposit,
Yeah.
and that would be still eligible for investors as well. So tips for saving a deposit. Look, my biggest advice for people saving a deposit is to just start doing it. I see so often people would prefer sit down and have a whinge about how much they can't afford it rather than actually doing it. You know, and if you actually sit down and work out what you need, I would work backwards. You know, if you're going to need 50K as an example, and your goal is to purchase in 3 years, what does that equal per week for you and your partner to save each week?
Yeah.
Now work backwards from it. Set a goal. We want to buy our first property in 3 years. We need $50,000. We need to save this amount each week.
Yeah. I think you could also look at it from, you know, because I always speak about as well, you know, in terms of your actual interest rate or loan repayments, you can also, you know, that's a big consideration for people who buy or invest in property. But for people who invest, it's also your rental return as well. So you can get, you know, that difference made up on both ends. But in terms for saving a deposit, of course you've got the savings component, but I think like it'd be really good for people to familiarise themselves with compounding, because compounding isn't just for leveraged assets, it's also compounding for, you know, savings, whether it's in, you know, a savings account or different ways to invest. So I think if people actually educate themselves on, you know, you can make money, a small amount of money from a small amount invested through a stock market, you know, but you have to, of course, familiarise yourself with whatever asset you're investing in. So, you know, there's a savings component, but I think you can also make money to try and shorten that period of time that you can invest.
But yeah, you just have to weigh up your risks of, well, I guess your risk tolerance, if you want to call it that, versus your patience.
Yeah, exactly.
And sort of make a decision based on that. Another thing that I've seen work really well for people that are employed, so not self-employed, is give your employer 2 bank accounts.
Yeah.
So you'll have one that just goes, you know, half your pay or 80% of your pay comes to you directly.
Yeah.
20% automatically gets split at payday and goes into another account.
Yeah.
Key to that is making sure that that account isn't linked to your internet banking. Yeah. So that you know, out on a Friday night and you go, I need another $50, $100, and you can just easily transfer it. It needs to be in an account that you don't have, I guess, the instant ability to be able to do that.
It's almost like it's not your money. If it's chocolate's not in the cupboard, you're not going to eat it.
Well, that's right. And we see it all the time. People will adjust to what they're getting paid to.
Exactly.
If you're getting paid stuff, or you'll do less, you'll stay at home, or you do all these things. People on high incomes spend their income as well. Yeah. At the end of the pay period, they've got just as much as someone on a low income because they're spending it all. Yeah. So,
I think given the time, we'll move on. But I think wrapping up on deposits, like regardless of the amount actually saved or whatever, I think it's best to just speak to a broker straight away to actually get an understanding of what the potential hurdles are going to come up against, but also what they're in for in terms of the amount that they can actually save, how much they're going to need, and what their future holds for actually getting a deposit.
Yep, 100%. So the next one that we're going to talk about is the government schemes on offer. So I guess I'll start with outlining some of the ones in New South Wales, because that's where we're from. Yeah. So the first one is this is for first home buyers, sorry, not for investors, but the first one is the first home loan deposit scheme. Mm-hmm. So that's a 5% deposit with no lender's mortgage insurance. Doesn't matter what industry you're in, as long as you earn less than a certain cap. Yeah. I think it's 125K or similar. It's close to that, 125K for a single and 200 for a combined couple. Yeah. So that is a great scheme for anyone wanting to buy their first home. But to be eligible for that, you need to live in it for 6 months within the first 12-month period. Yeah. So the next one, is the, what do you call it? The stamp duty exemption. Yeah. So again, need to live in it for 6 months out of the first 12 months. But that could save you, you know, a $500,000 purchase. What's that? $25,000 or, you know, it's a lot.
So if you're an investor, these two don't apply to you.
None of them actually apply. Yeah. So to be clear, if you are buying it and not going to live in it, there is no schemes available for you. So I guess the point of bringing this up is it is sometimes worthwhile buying it, living in it for 6 months, moving out.
Yeah.
And there you go. You know, you've bought your first investment property via living in it for 6 months or 12 months or whatever you want to do. But then you've saved, you know, let's call it 25 grand in lender's mortgage insurance and 25 grand in stamp duty.
Yeah.
It's not a bad 6 month earner.
Yeah.
Then you move out.
Yeah.
You know, you've ticked off your first home buyer grant eligibility, and then you go. Because once you buy your first, they're gone anyway.
Yeah.
You're not getting them back.
Yeah. Take advantage of them while they're there.
Although I lie, because the first home loan deposit scheme one, which is the 5%, if you haven't owned a home for more than 10 years,
interesting,
eligible again.
Yeah.
But again,
well,
you've missed
that's
out.
sort of the average hold period for homes. So
but you've missed out. You've missed
years.
out on 10 years worth of capital growth though, because you haven't owned something in 10 years.
Yeah.
So
yeah,
it's there's also ones around single parents as well that sort of tie into that first home loan deposit scheme as well.
Yeah.
But the basics of it are, I guess, to summarise that, if you're buying it to rent out and you've never owned a property before in Australia, you will miss out on all the first home buyer schemes.
Yeah.
It's as simple as that.
Yeah.
Now, next one is literally what I do on a daily basis, is working out people's borrowing capacities as a mortgage broker. Yeah. So the simple equation for that is literally it's your net income minus your net expenses.
Yeah.
So we work out, you know, basically how much they've got at the end after their tax comes out, after their HECS, any other deductions. So they might have salary sacrifices, any of these different things on their pay slips. We then get a net. Then out of that net, your living expenses come out. So you could tell me that you only spend $100 a week in groceries, which we know that's full of shit. That is not possible. If you told me that, it wouldn't matter anyway, because the lenders use what's called a household expenditure measure, so a HEM. Yeah. So basically that's an average over all of Australia, or even they think they subcategorize it into sort of states and regions, even city versus regional. Yeah. Each lender has a different HEM. So they're going to use that anyway. Yeah. So you've got your net income minus that HEM amount, or if you're actually above that HEM, they'll use the higher of the two. Yeah. So it's what we always get the living expenses from a client, and then we work with them. And I would say it's an interesting stat. I think ASIC stated a couple of years ago that 85% of households are actually spending more than the HEM amount.
Well, if people actually want access to that data, it's free online through informed decisions in the housing category.
So 85% of people are above HEM, yet when we take people's living expenses, I would say maybe only 10% would declare to us that they're spending more than HEM.
Yeah.
So we sit down with them, we sort of educate them that this is not going to increase your borrowing capacity by telling us you spend less, because they're going to use a minimum anyway. Yeah. So then obviously what you've got left after net income minus your living expenses, then we've got, I guess, if you want to call it disposable income. Yeah. Now, out of that amount is loan repayments. So if you've got existing loans, so if you've got a personal loan, credit cards, all these things, there's not going to be much left at the end, is there? Yeah. And what's left at the end needs to then cover your proposed loan repayments at a buffered rate. Yeah. So let's say the interest rate you're applying for is 6.19. They're not going to calculate your capacity to repay that at 6.19. It's going to be at 9.19. Yeah. 3%.
And I think that's important for people to hear, because although that's your maximum borrowing capacity, it's not your maximum capacity to repay the debt.
No.
So there already is a buffer there, and most likely a lot of purchasers are putting their own buffers in place regardless anyway. So,
but I guess on that, during COVID, when rates were 1.99, the assessment rate, I think the minimum assessment rate was 5.25 from memory.
It was a 2.5% buffer, wasn't it?
Yeah, so we're above that.
Yeah.
So that's where that 30% mortgage stress figures are coming from at the moment, because there was a huge amount of people that were absolutely maxing themselves out of that 5.25 assessment rate. Yeah. And now we're above that. Literally, they can't afford it. Yeah. On paper, they're going backwards.
And on that as well, with a lot of people thinking that interest rates were a big dictator during that time, and of course they were, but it was also the most amount of money in Australian bank accounts than ever before.
Yep, high savings.
Yeah. So, like you said, when you've got the money to spend, you typically spend it.
Yep, 100%. And one of the reasons why that assessment rate is still so high is, I guess, ease of access to credit is a big factor in the economy.
Yeah.
And if they lower that now, it'll fire off the property market again, increase inflation.
It doesn't need any more pressure.
We don't need that.
No.
So although APRA is the body that govern banking, although they have admitted on several occasions that they do not think that rates will ever get to 9.19, they are not willing to lower that assessment rate.
Yeah.
So I actually don't think it's a bad idea.
Yeah.
It's as I said, during COVID, I did see a lot of people try and max themselves out with that assessment rate at 5.25. We're above that now.
Yeah.
It's scary.
Yeah.
So I guess some quick tips on that. Don't, like, your credit cards, your personal loans, all those things that you probably don't really need are going to really affect your borrowing capacity.
Yeah.
So you look at a credit card with a limit of $10,000, the lender will actually calculate your repayment based on the limit, not what you owe.
Yeah.
So let's say you've got a $10,000 limit, it's 3.8% of the limit, not what you owe. So that's $380 a month that they're going to put into that servicing calculator.
Yeah.
Which is a lot.
Yeah. That's massive.
That's almost $100 a week.
If people have got $10,000 or $20,000, balances, if you don't need it, well then, try and get rid of your credit cards. I 100%. Think, but at least reduce them down to the minimum.
What I would recommend in those cases, like, credit cards are shit. Let's be clear. I hate them.
Yeah.
Can't stand them. I don't have one myself.
Yeah.
If you do get into that trap, because the way they set up those minimum repayments, you're never going to pay off the debt. It's literally, I think, worked out to be, if you paid the minimum each month, it's like a 99-year term. Isn't that bad? So don't pay the minimum. If you do get one, firstly, don't pay the minimum.
Sounds like hex.
You're just spinning the wheels. Yeah, by the time they index it every year, you're never getting anywhere with it. But you're much better off consolidating those credit cards into a personal loan. There's heaps of personal loan lenders out there that will do a 7-year term with no early repayment fees. Yeah. You're going to pay it off in 7 years, then you know that. Yeah. And I can guarantee so many people, especially in this current market, that have got $20,000, $30,000 worth of credit card debt, they're paying the minimum because they can't 100%. Afford anything else. Yeah. And the amount of interest you're paying on it, these are 25% interest credit cards.
Massive. A cheap one's 15.
It's ridiculous. Yeah, well, that's right. That's a cheap loan. Yeah. Imagine, because I obviously own the car loan company as well. Imagine if we were selling giving car loans to people at $30,000, $40,000 at 25%. Yeah. People would be blowing up, but they're happy to go out and get $40,000 worth of credit card debt.
Pay 20% on dinner.
Exactly. Well, that's right. That's an indication of you going backwards as well. If you're piling everything into a credit card, you're not earning enough to cover your expenses. It's as simple as that. Exactly. You really need to sit down and look at what is actually going on. Yeah. If it's mortgage stress, you could possibly reach out to your lender and try and go interest only or something like that to cover that period for a while until you do get back on your feet. But credit cards is not the answer.
I think an important one for borrowing capacity, and purely because I know that there's a lot of people in their 30s to 40s at the moment who are first-time investors or first-time home buyers, and it's typically the time when people are considering kids. Yeah. So from a broker's perspective, should you consider buying before having kids?
Yes. Yeah. Simple answer. Yeah. Yes. When we look at that HEM, we talked about the expense measure. HEM, I think off the top of my head, most lenders add between a sort of $500 to $600 per child into your HEM. Yeah.
Now, which is 25 grand a year?
It's massive. Yeah. So you add one child in, boom, there goes, $100,000, couple of $100,000 worth of borrowing capacity. Yeah. When realistically, I've got 3 kids and they don't cost, $1,800 a month. Yeah. Like, it's a bit of a ridiculous sort of figure that they've pulled out there. But at the same time, it is a study on all the households and spending measures. So I guess there's a bit of credibility to it. But for me,
their risk profile.
Yeah, it is what it is. But
definitely, if you have the opportunity to buy before kids, you'll be able to borrow more.
Yeah.
It's as simple as that.
Yeah.
Now, I think that's pretty much covers that. If you want to increase your borrowing capacity, you need to earn more, spend less. Simple as that.
Yeah.
Getting a guarantor, getting someone else to throw in your more deposit will not increase your borrowing capacity. It might increase your your purchase price if you're putting more cash in, but it's not going to increase your borrowing capacity at all.
And look, I think really we can sit here and throw all of the advice out there that we want, but it's the same as the gym scenario. We all know how to diet and exercise. We all know how to save and not spend. So it's whether you have the discipline to actually do it.
Gyms make money off people that don't show up. Simple as that. But look, the people that, I guess back on that, a little bit of the psychology part to it, people that actually want to do this shit will make it happen.
Yeah.
If you're agonizing and I can't do this, you need to really snap out of that mindset and just make it happen. Whatever that happens. If you're in an industry where you're not earning enough money, consider changing industries, as ridiculous as that might sound.
Yeah.
Go to uni, go do a TAFE course, do something about it. Don't just sit there for the next 15, 20 years and whinge about it and complain in 20, 30 years that you've got nothing.
Yeah.
Now is the time for you to make some changes to make your life better.
Exactly.
Don't wait for someone else to do it for you. That's my rant. That's the TED Talk.
Last one we'll touch on before we wrap up. And this sort of is a good transition for the next segment, which is first-time investors or buyers for an actual property advice. But the last one is rent vesting.
Rent vesting is essentially where you can't afford to purchase where you live. So let's use Newcastle as an example. You're probably better to answer, but I'd say at an estimate, the median house price would be above 900, would it? Newcastle Greater Region?
Yeah. Typical price is for Newcastle is $990 or $980.
Yeah. So at a guess, a single earning $90,000, just don't quote me on this, but their borrowing capacity is probably going to be about $400K.
Yeah.
It's not great at the moment.
Yeah.
Add in some expenses and some credit cards and that drops really quick.
Yeah.
So all of a sudden, there's no way a single person is going to be able to buy in Newcastle.
Yeah.
So all of a sudden, do they just go accept defeat and go, I'm never going to buy a house?
Yeah.
Or do they go, you know what, stuff it, I'm going to keep living at Honeysuckle in an apartment because I love that. I can wander down to the pub after work, whatever. They get to live their lifestyle. But then they use their borrowing capacity to purchase in a market that's affordable.
Yeah.
I know everyone's going to Perth at the moment or South Australia or wherever.
Yeah.
Perth market's a bit volatile. I think they all are. But you're still better off, in my opinion, having that property than not having it.
100%. And look, this is one, like rent vesting's extremely popular for people living in Sydney because it's the most unaffordable city in Australia to live in.
I think it made top 5 or something in the world, didn't it?
Yeah, it's up there in the world. So there's a lot of rent vestors coming out of Sydney. People want to stay in that city, but they need to put their money elsewhere. And it's, Newcastle's very similar to a lot of the coastal suburbs down there. So a lot of people from Sydney actually buy Newcastle with the rent vesting strategy. So the Newcastle subreddit, there's a lot of people, 75,000 people in that subreddit from Newcastle, and a lot of them you see, complaining about the amount of Sydney people buying in Newcastle at the moment.
Yeah.
And fair point. There's a lot of people, increasing house prices here and pushing people out of that market. But the same can be said for people in Newcastle with that rent vesting strategy, investing in other states.
Overall, I think it's a good strategy. Realistically, you can't, as you said, 990 is the average in Newcastle. What's the average in Northern Beaches?
Yeah.
No way.
Yeah.
No way you're getting that as a first-time investor or first-time buyer.
Yeah.
So, you're essentially going out, you're buying somewhere with good capital growth.
Yeah.
You're going to use that at a later date to probably buy
100% back in Newcastle.
Or back in Sydney.
Yeah.
So as far as linking that back to borrowing capacity, I'll wrap that up quickly. The lenders do not take 100% of the rental income.
Yeah.
And plus you've got to expense your rent, or if you're staying with parents, most lenders will use around $650 a month.
Yeah.
So it doesn't increase your borrowing capacity a huge amount, but it's still an option.
Yeah.
You're never going to buy at that $2 million mark in Sydney. So doing this is a good way to do it.
You just need to make sure that you can afford it.
Yeah.
Sit down, work out exactly what it is going to cost you each week on top of your rent, on top of living with your parents or whatever you're doing, and work backwards from there.
Yeah.
So that's a bit of a wrap up for today then. As always, jump on, like all the Facebook page and the Instagram, and jump in the Facebook group, and reach out if you have any questions or if you have anything that you want us to talk about specifically. And next week we're going to be talking about, I guess, the property side, and you know, we might discuss a little bit about property selection. And
this conversation continues, part 2.
Part 2 next week. Thanks, guys.
Thank you.